Listen to me very carefully, because what I'm about to tell you changes everything about how you should be thinking about precious metals right now. Bank of America just published research that projects gold could reach $5,000 per ounce under their upside scenario. Not speculation, not YouTube conspiracy theories. Bank of America Global Research, one of the most conservative institutional research houses on Wall Street, just put their name behind a $5,000 gold target. And here's what nobody's explaining. This isn't primarily about gold. This is about what $5,000 gold mathematically means for silver. Because when gold moves to $5,000, the entire precious metals complex reprices, and silver, with its smaller market size, higher volatility, and historical correlation patterns, doesn't just follow gold higher, it amplifies the move. By the end of this video, you're going to understand exactly why Bank of America chose $5,000 as their upside scenario, not $4,000 or $6,000, but specifically $5,000. You'll know what drives institutional forecasts at this level and why major banks don't publish these numbers unless the analytical foundation is bulletproof. And most importantly, you'll understand what $5,000 gold means for silver prices using nothing but mathematics, historical ratios, and market structure analysis that any professional metals trader would recognize immediately. Let's start with what Bank of America actually said, because precision matters when you're dealing with institutional research that moves billions in capital. According to Reuters reporting on Bank of America's official forecast, the bank projects gold could average $4,538 per ounce in 2026, with upside scenarios reaching $5,000 amid central bank buying and fiscal instability. That's the base case and the upside case stated explicitly. Average price, $4,538. Upside scenario, $5,000. Two different projections for two different probability scenarios. The $4,538 figure represents Bank of America's expected value, their probability-weighted forecast for what gold will actually trade at on average throughout 2026. That's not a wild guess. That's their institutional research team's best estimate, given current data, trends, and forward-looking models. The $5,000 figure represents their upside scenario, what happens if certain risk factors intensify beyond base case assumptions. Geopolitical tensions escalate, fiscal deficits expand faster than expected, central bank buying accelerates, dollar weakness intensifies. Under those conditions, which Bank of America views as plausible but not guaranteed, gold reaches $5,000. Now here's what makes this research significant beyond just another price forecast. Bank of America doesn't publish wild speculative targets. They're not a precious metals dealer trying to sell bullion. They're not a mining company talking their book. They're a major institutional research house providing analysis to sovereign wealth funds, pension managers, hedge funds, and high net worth clients who make allocation decisions based on their research. When Bank of America publishes a $5,000 upside scenario, that number went through multiple layers of research validation, risk committee review, and compliance approval. They're staking their research credibility on the analytical foundation supporting that target. And that foundation, according to Michael Widmer, head of metals research at Bank of America, rests on three primary drivers: sustained central bank accumulation, fiscal instability across developed economies, and gold's role as the primary hedge in portfolio construction during periods of monetary uncertainty. Let me break down each of these drivers, because understanding why Bank of America projects $5,000 gold is essential before we can understand what it means for silver. Driver 1. Central bank buying at historic levels. According to the World Gold Council, which tracks official sector gold purchases globally, central banks purchased over 1,100 metric tons of gold in 2024, continuing into 2025, representing the highest sustained buying in modern history. This isn't seasonal fluctuation. This isn't noise. This is structural reallocation of sovereign reserves away from dollar-denominated assets toward physical gold. The buyers aren't small emerging markets. China's central bank reported continuous gold purchases. The Central Bank of Poland increased reserves substantially. The Central Bank of Singapore accumulated gold. Even the Reserve Bank of India and Central Bank of Turkey, historically significant buyers, maintained aggressive purchasing programs. Bank of America's research explicitly cites this central bank demand as a foundational support for higher gold prices because central banks don't trade tactically. When central banks buy gold, they're making decade-long strategic allocation decisions. They're not flipping positions based on quarterly performance. They're rebalancing sovereign reserves for generational timeframes. That demand is sticky, sustained, and structurally supportive of higher prices because it removes supply from the market permanently. When Bank of America models $5,000 gold scenarios, they're incorporating the assumption that central bank buying continues at elevated rates or accelerates further. If central banks globally are adding 1,000 plus tons annually to reserves, that's approximately 3% of total annual gold mine production being absorbed by buyers who never sell. That structural deficit between supply and demand creates the foundation for sustained price appreciation. Driver 2, fiscal instability and debt dynamics. According to IMF data and BIS quarterly reviews, developed economy government debt to GDP ratios have reached levels historically associated with either default, inflation, or financial repression. The United States is running trillion-dollar deficits during economic expansion, something unprecedented outside of wartime or deep recession. European sovereigns face debt sustainability questions as demographics worsen and social spending obligations grow. Japan's debt to GDP exceeds 250%. These aren't short-term, cyclical deficits. These are structural imbalances that compound annually, creating existential questions about the long-term purchasing power of fiat currencies issued by these governments. Bank of America's $5,000 scenario explicitly incorporates the assumption that fiscal concerns intensify rather than resolve, not catastrophic collapse, but continued erosion of confidence in fiscal sustainability, which drives portfolio diversification into hard assets that can't be printed, diluted, or defaulted on by governments. Gold is the asset that benefits most directly from fiscal instability concerns because gold has no counterparty risk, no government backing, and no dilution risk. When investors lose confidence in government bonds, they don't rotate to corporate bonds or equities, they rotate to gold. Bank of America is modeling a scenario where that rotation accelerates as fiscal concerns move from theoretical to urgent in investor consciousness. Driver 3, gold as primary portfolio hedge. According to Michael Widmer's statements reported by Kitco News, gold remains the primary hedge in the current environment, not Bitcoin, not real estate, not commodities broadly. Gold specifically serves as the portfolio diversification and risk hedge that institutional investors rely on when traditional 60-40 stock bond portfolios face simultaneous pressure from inflation and growth concerns. Bank of America's research positions gold as alpha source, meaning gold isn't just preserving wealth, but generating positive returns in excess of risk-free rates during this cycle. That's a significant analytical claim. Calling gold an alpha source rather than just a hedge implies Bank of America expects gold to outperform broad market indices on a risk-adjusted basis. The $5,000 scenario reflects that conviction. If gold is genuinely the primary hedge and alpha source during a period of monetary instability, and if institutional portfolios are underweight gold relative to optimal allocations given current risk conditions, then capital flows into gold could be substantial and sustained. Bank of America is modeling what happens when those flows materialize. Put these three drivers together, and you have the analytical foundation for $5,000 gold. Central banks buying aggressively, fiscal conditions deteriorating structurally, institutional portfolios rotating toward gold as primary hedge. Each driver individually supports higher prices. Combined, they create conditions where $5,000 becomes not just possible, but plausible under stress scenarios. That's why Bank of America published that specific number. Not because it sounds impressive, but because their modeling of these drivers under intensified assumptions produces that price target mathematically. Now here's where this gets interesting for anyone who cares about silver, because Bank of America's gold forecast isn't just about gold, it's about the entire precious metals complex. And silver's relationship to gold is one of the most studied, most documented, and most reliable correlations in commodity markets. Let me show you why $5,000 gold changes everything for silver, using nothing but math and historical observation. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold around $2,800 and silver around $90, the ratio sits approximately 31 to 1. That means 31 ounces of silver equals the value of 1 ounce of gold. This ratio fluctuates constantly as gold and silver prices move at different rates. Sometimes gold rallies faster and the ratio expands. Sometimes silver rallies faster and the ratio compresses. But over long periods, this ratio exhibits mean reversion tendencies around historical averages. According to analysis from Investopedia and multiple precious metals research sources, the 20th century average gold-silver ratio was approximately 47 to 1. During precious metals bull markets, the ratio tends to compress significantly below that average as silver outperforms gold percentage-wise. In 1980, during silver's historic squeeze, the ratio compressed to approximately 17 to 1. In 2011, during silver's last major bull market, The ratio compressed to approximately 32 to 1 at its tightest. Currently at 31 to 1, we're already at levels that historically mark strong silver performance relative to gold. We're at compression levels seen during peak bull market conditions. But here's what Bank of America's $5,000 gold projection means for this ratio. If gold reaches $5,000 and the ratio stays at current 31 to 1 levels, silver would be at $161 per ounce. That's just arithmetic. $5,000 divided by 31 equals $161. No speculation, no conspiracy, just division. But that scenario assumes the ratio stays constant at current levels. History says that's not what happens during gold bull markets. History shows the ratio compresses further as silver amplifies gold's gains during strong precious metals rallies. If gold reaches $5,000 and the ratio compresses to even moderate levels around 40 to 1, which is below the 20th century average and well above historical bull market extremes, silver would be at $125 per ounce. If the ratio compresses to 2011 levels around 32 to 1, silver reaches 150 sigtar. If we see compression toward 1980 extreme levels around 20 to 1, silver reaches $250. These aren't predictions. These are mathematical scenarios showing what silver prices would be at various ratio levels if gold hits Bank of America's $5,000 target. The scenarios span a range from conservative ratio assumptions to aggressive historical precedent. But every single scenario has silver substantially higher than current prices, not because of silver-specific catalysts, but simply because gold is going higher and silver maintains historical correlation patterns. That's why Bank of America's gold forecast matters so much for silver investors. The gold call implies a silver call through mechanical mathematical relationships that don't require any additional speculation or assumptions beyond what happens to the ratio during gold bull markets. Now let me show you why the ratio compression isn't just hopeful thinking, but historically documented behavior with fundamental drivers that professional analysts recognize and model. Silver doesn't just follow gold mechanically. Silver has its own supply-demand fundamentals that create conditions favoring outperformance during precious metals bull markets. According to the Silver Institute, global silver supply faces structural deficits as mine production remains relatively flat while industrial demand continues growing. Silver demand comes from two major sources: investment demand, like gold, plus industrial demand, unlike gold. Photovoltaic solar panels consume approximately 20% of annual silver production. Electronics manufacturing uses silver extensively. Electric vehicles require significantly more silver than traditional vehicles. 5G infrastructure and data centers use silver in critical applications. This industrial demand is growing secularly as technology adoption accelerates, and green energy transitions require more silver-intensive infrastructure. Gold, by contrast, has minimal industrial demand. Gold is almost entirely investment and jewelry demand. When investment demand for precious metals surges, gold and silver both benefit. But silver gets an additional boost from simultaneously strong industrial demand. That dual demand dynamic is what drives ratio compression during bull markets. According to Bank of America's own research referenced in multiple reports, silver's smaller market size creates higher volatility and larger percentage moves for equivalent dollar flows. The total investable silver market is estimated at approximately $200 to $300 billion globally. Gold's investable market exceeds $12 trillion. When institutional money flows into precious metals, the same dollar amount moving into silver creates dramatically larger percentage price impacts than the same amount moving into gold. A $10 billion flow into silver could represent 3 to 5% of the entire market. The same $10 billion into gold barely registers as 0.08% of the market. That size differential means silver amplifies gold's moves during bull markets, because smaller market size plus dual demand equals bigger percentage gains. Bank of America's analysts understand this market structure dynamic. When they project $5,000 gold scenarios, they're implicitly acknowledging that silver likely outperforms gold significantly if those scenarios materialize, even if they don't publish specific silver targets in every report. The market structure and historical correlation patterns are too well documented for professional analysts to ignore. Now here's the part that makes Bank of America's $5,000 projection more than just academic forecasting. They're not alone. Multiple major institutional research houses are publishing similar upside scenarios for gold, creating a consensus view among professional analysts that substantially higher gold prices are plausible under realistic market conditions. According to reports aggregated through Bloomberg Terminal and Refinitiv, J.P. Morgan Asset Management, published parallel research noting that gold benefits structurally from sovereign debt expansion and reserve diversification. Goldman Sachs raised gold forecasts, citing similar central bank demand dynamics. UBS highlighted gold's role in portfolio construction during periods of elevated geopolitical risk. These aren't fringe voices. These are the largest, most conservative institutional research houses globally. When multiple major banks independently arrive at similar conclusions about higher gold prices, that convergence matters. It suggests the underlying analytical foundation is robust, not dependent on any single analyst's view or methodology. The drivers supporting higher gold prices, central bank buying, fiscal concerns, portfolio diversification demand are observable facts that multiple research teams are incorporating into forward-looking models and reaching similar conclusions. For silver investors, this institutional consensus on gold has profound implications. If multiple major banks see $4,500 to $5,000 gold as plausible, and if historical ratio relationships hold even partially, then silver at $120 to $160 isn't speculation. It's mathematics applied to institutional consensus forecasts. You don't need to believe in silver manipulation theories. You don't need to assume industrial demand explodes. You just need to believe Bank of America, JP Morgan, and Goldman Sachs are correctly analyzing gold fundamentals, and then apply basic arithmetic using historical ratio ranges. That's why this analysis is so compelling. It's not dependent on silver-specific catalysts. It's dependent on gold doing what major institutional banks are now forecasting, combined with silver maintaining historical relationships to gold that have held for decades. Now let me address the elephant in the room, because I know exactly what some of you are thinking. If this is so obvious, if the math is this simple, why isn't everyone buying silver right now? Why isn't silver already at $150 if Bank of America sees $5,000 gold? The answer reveals something important about how markets actually work versus how people think they work. Markets don't price in scenarios before they happen. Markets price in probabilities as they evolve. Bank of America's $5,000 gold projection is an upside scenario, not a base case certainty. Their actual forecast is $4,538 average for 2026. The $5,000 figure represents what happens if risk factors intensify beyond base case assumptions. The market isn't going to price silver for $5,000 gold until either gold actually approaches $5,000 or the probability of $5,000 gold increases substantially from current market implied probabilities. Right now, gold is trading around $2,800. For gold to reach $5,000 requires approximately 80% appreciation from current levels. That's not happening overnight. That's a multi-quarter, possibly multi-year process if it happens at all. Silver isn't pricing in $5,000 gold today because $5,000 gold isn't certain today. It's a scenario. A plausible scenario with serious institutional research supporting it, but still a conditional projection based on specific assumptions about how central bank buying, fiscal conditions, and portfolio flows evolve. As those assumptions get validated or invalidated by actual data over coming quarters, markets will reprice accordingly. If central bank buying continues at elevated rates, gold moves higher, silver follows, ratio dynamics play out, and prices converge toward the scenarios Bank of America outlined. If central bank buying fades, if fiscal concerns ease, if alternative hedges become more attractive, then the $5,000 scenario becomes less probable and prices adjust downward. Markets are forward-looking probability discounting mechanisms. They don't price in upside scenarios as certainties. They price in evolving probabilities as information arrives. That's why understanding Bank of America's research matters, even if silver hasn't already spiked to $150. You're getting analytical framework and scenario roadmap before the market fully prices in those scenarios. You have the opportunity to position ahead of probability updates if you believe the drivers Bank of America identified are likely to intensify rather than fade. That's what professional investors do with institutional research. They don't wait for scenarios to fully materialize before positioning. They assess scenario probability, size positions accordingly, and adjust as new information arrives. Bank of America gave you the scenario framework. Now you evaluate probability and position appropriately for your own risk tolerance and conviction level. Let me show you what smart positioning looks like given Bank of America's research, because this isn't about going all in on silver futures or betting your house on $5,000 gold. This is about incorporating scenario analysis into diversified portfolio construction. First, evaluate your current precious metals exposure. Most portfolios are underweight precious metals relative to optimal allocations during periods of monetary uncertainty. Traditional 60-40 portfolios typically hold 0 to 2% in precious metals. According to portfolio optimization research during periods of elevated inflation and fiscal concern, optimal precious metals allocation ranges from 5 to 10% of portfolio value. If you're currently at 0 or 2%, Bank of America's research provides analytical justification for increasing toward 5% as base case positioning. Second, decide on gold versus silver allocation within precious metals. If you believe ratio compression is likely during a gold rally, tilt allocation toward silver. Maybe 60% gold, 40% silver instead of 80-20 or 90-10. That positioning captures silver's upside leverage if compression occurs, while maintaining gold as portfolio anchor and primary hedge. If you're more conservative or skeptical about ratio compression, stay heavier in gold, maybe 75-25 or 80-20, but maintain some silver exposure to participate if historical patterns repeat. Third, consider timeframe and implementation. If you're positioning for Bank of America's 2026 scenarios, physical bullion or ETFs like GLD and SLV offer direct exposure without time decay. If you want leveraged exposure or defined risk, consider long-dated call options on silver or silver mining ETFs. Options offer convex payoff profiles where you participate in upside scenarios while limiting downside to premium paid. That's attractive when positioning for low probability, high impact scenarios like $5,000 gold driving silver to 150 plus MIRM. Fourth, establish monitoring framework and adjustment triggers. Don't just buy and forget. Track the variables Bank of America identified as scenario drivers. Monitor central bank gold purchases quarterly through World Gold Council reports. Watch fiscal deficit trends through government budget data. Follow gold price momentum and technical levels. If gold breaks above $3,000 convincingly, probability of $5,000 scenario increases. If gold stalls at $2,800 or retreats, probability decreases. Adjust positioning accordingly using rules-based triggers rather than emotional reaction. Fifth, look for asymmetric opportunities beyond just long silver. Silver mining stocks offer operational leverage to higher silver prices. A company producing silver at $15 per ounce all-in sustaining costs sees profit margins explode if silver goes from $90 to $150. That margin expansion drives equity values substantially higher than the underlying commodity. Junior miners with development projects that become economically viable at higher silver prices offer even more leverage but with higher risk. Streaming companies that own silver revenue rights without operating mines provide exposure with different risk profiles. The point is, Bank of America's gold research creates opportunity across the precious metals value chain, not just in silver spot prices. Professional investors look for multiple ways to express conviction across risk-reward profiles, appropriate to different portfolio sleeves. This is sophisticated portfolio construction using institutional research to inform allocation, not gambling on price predictions. Bank of America provided the analytical framework. You implement it intelligently within your own portfolio constraints and objectives. Now let me address the scenario where Bank of America is wrong, where $5,000 gold doesn't happen, because understanding downside is as important as understanding upside when making investment decisions. What would invalidate Bank of America's $5,000 scenario? What conditions would suggest the projection is too optimistic? First, central bank buying could slow or reverse. If major central banks stop accumulating gold, or worse, begin selling reserves, that removes a major pillar of the bull case. Central bank demand has been the marginal buyer setting price for the past several years. Without that bid, gold struggles to maintain current levels, let alone rally to $5,000. Monitor World Gold Council data quarterly. If you see sustained decline in central bank purchases, that's a red flag for the $5,000 scenario. Second, fiscal conditions could improve unexpectedly. If governments implement credible deficit reduction plans, if economic growth accelerates sufficiently to improve debt to GDP ratios, if inflation remains controlled without requiring aggressive monetary tightening, then fiscal concerns ease and the hedge demand for gold diminishes. Fiscal sustainability improving is bearish for gold because it reduces the rationale for hard asset diversification away from government bonds. Third, alternative hedges could become more attractive. If Bitcoin gains wider institutional acceptance as digital gold, some capital that might have flowed to physical gold could flow to Bitcoin instead. If real yields on government bonds increase substantially, making bonds attractive relative to zero-yielding gold, portfolio allocations shift away from gold toward bonds. If equity markets continue strong bull trends with manageable volatility, investors see less need for portfolio hedges generally. Any of these alternatives gaining attractiveness relative to gold undermines the $5,000 scenario by providing competition for capital flows. Fourth, dollar strength could persist or accelerate. Gold is dollar denominated and tends to move inversely to dollar strength. If the dollar index rallies substantially due to U.S. economic outperformance, higher real yields, or capital flight to safety during geopolitical crises, that creates headwinds for gold prices. Bank of America's $5,000 scenario implicitly assumes dollar weakness, or at minimum dollar stability. Sustained dollar strength would challenge that assumption. These are the factors that could invalidate Bank of America's bullish gold scenarios. None are currently materializing in ways that undermine the base case, but all are worth monitoring. If you see multiple invalidation factors emerging simultaneously, that's when you reduce precious metals exposure and reposition toward assets benefiting from the alternative scenario. Intelligent investors don't marry positions. They marry analytical frameworks and adjust positions as data evolves. Bank of America gave you the bull case framework. Understanding the bear case factors makes you a complete analyst capable of objective assessment rather than biased cheerleading. Now, here's the thing that separates professional investors from retail speculators when it comes to institutional research, like Bank of America's $5,000 gold projection. Professionals don't read the headline number and immediately execute trades. They read the research, extract the methodology, evaluate the assumptions, assess the probability distribution across scenarios, and then make incremental portfolio adjustments sized appropriately to conviction level and portfolio risk constraints. The $5,000 gold scenario gets attention because it's a big round number that makes headlines. But the actual value in Bank of America's research isn't the specific price target. It's the analytical framework explaining what drives gold prices under different conditions, what central bank buying means for supply-demand balance, how fiscal instability creates demand for monetary hedges, why gold serves unique portfolio diversification functions, and how these factors interact to produce a range of possible outcomes from base case to upside scenarios. That framework is durable. That framework applies regardless of whether gold specifically hits $5,000 or tops out at $4,500 or $4,800. That framework helps you understand precious metals markets in real time as conditions evolve. You can apply that framework yourself continuously. You don't need to wait for Bank of America's next research update. You can track central bank buying data monthly. You can monitor fiscal conditions as governments release budget data. You can watch portfolio flow data through ETF inflows and futures positioning reports. You can observe gold's price action relative to other assets and assess whether the hedge characteristics Bank of America describes are playing out in real time. The framework makes you an informed participant capable of independent analysis rather than a passive consumer of price predictions. That's the real value of institutional research when used correctly. Bank of America's $5,000 gold projection matters because it represents serious institutional analysis supporting substantially higher precious metals prices based on observable fundamentals and documented market dynamics. It matters because it validates a scenario that many investors suspected but lacked institutional confirmation for. It matters because it provides analytical framework and probability roadmap that you can use to make better informed positioning decisions in your own portfolio. And it matters for silver specifically because of the mathematical and historical relationship between gold and silver prices through the gold-silver ratio. When the most conservative institutional banks on Wall Street start publishing $5,000 gold scenarios, when they cite central bank buying, fiscal instability, and portfolio diversification as structural drivers, when they frame gold as alpha source rather than just wealth preservation, that's a signal that precious metals, as an asset class, are entering a different regime. And in that regime, silver's smaller market size, dual demand profile, and historical correlation patterns mean it doesn't just participate in gold's rally, it amplifies it. The math is simple. The history is documented. The institutional research is now confirming the framework. Whether you position accordingly is entirely your decision based on your own circumstances, risk tolerance, and conviction. But understanding what Bank of America's $5,000 gold projection means for silver requires nothing more than arithmetic applied to historical ratio ranges. And that arithmetic suggests that if Bank of America is even partially correct about gold's upside potential, silver has substantial room to run simply by maintaining historical relationships. Not because of manipulation, not because of conspiracy, because of mathematics, market structure, and institutional research now confirming what the fundamentals have been suggesting. That's what changed overnight when Bank of America published their $5,000 gold scenario. The math for silver just got a lot more interesting.